Okay, Chapter 7, Part 2. For Chapter 7, Part 2, both of the problems that I'm going to do are ones that are assigned to you. Again, your problem is just going to have different numbers, like some of the other ones that I've done that are similar to that. Okay, so let's look at this first one. This is problem number 70, and it has to do with education tax credits. Hopefully, as you're reviewing all this education tax credit stuff and things in this book that actually apply to you as a student, hopefully those are sections of the book that are actually kind of fun and interesting. It's always fun when we learn stuff that actually applies to us in our own situation rather than some situation that you may or may not ever see at any point in your life. So I always find these chapters and these sections of chapters to be particularly interesting. Okay, so let's look at this one. Janie graduates from high school in 2018 and enrolls in college in the fall. Her parents, who file a joint return, pay $4,000 for her tuition and fees. And then first, assuming that her parents have adjusted gross income of $170,000, what is the American Opportunity Tax Credit they can claim for Janie? So for this one, we have to pay attention to a few things. Number one, the income of her parents. Her parents make a lot of money. And if you go back and look at Learning Objective 7.5, and the easiest place I think to go for just what I want to point to is on page 7-49. These key points that are summarized at the end of the chapter sometimes are a really kind of easy way to look important things up. So in that Learning Objective 7.5, there's some information in there that we need to know about how much of a tax credit we can look at. So first, the partially refundable American Opportunity Tax Credit is 100% of the first $2,000 of tuition. So for sure, $2,000. And 25% of the next $2,000. So they paid $4,000, so there definitely is the next $2,000. And then what would be 25% of the next $2,000? 25% of $2,000 or 1/4 of $2,000 is $500. So $2,500, but we can't just have $2,500 as being the answer to Part A. It actually is the answer to Part B, so we can actually just talk about Part B because Part B is a lot more simple. Here, this is assuming that her parents have adjusted gross income of only $75,000. Well, that is less than the amount at which the credit starts to get phased out. So looking in that same key point box on page 7.49 or 7-49, you can see that the American Opportunity Tax Credit is phased out for joint filers with income between $160,000 and $180,000. In Part B, her parents aren't even near $160,000. So for sure, the answer to Part B is $2,500. But we need to do a little bit more calculation to get the answer to Part A because in that situation, her parents have adjusted gross income of $170,000, which is above that $160,000 threshold where it starts to get phased out. So let's calculate how much gets phased out. So the credit is going to be reduced by the $2,500 times the amount by which their adjusted gross income is over the $160,000. So, for example, their adjusted gross income is $170,000. The amount where it starts to get phased out, $160,000. Divided by $20,000. So the $20,000 is the difference between 160,000 and 180,000. So basically this calculation is showing what percent over $160,000 is their adjusted gross income. So we need some brackets here so that my formula actually looks correct. Remember all that order of operation stuff from math? Okay. No. There we go. Okay, so let's figure that out. So it's going to be $2,500 times the answer to what's in here in parentheses. So we have 2,500. You know what? I'm going to go to the next line because I like it when everything lines up. So it's going to be 2,500 times 170,000 minus 160,000 is 10,000 divided by 20,000. $2,500 times 10,000 divided by 20,000. That's 50%, right? Or 0.5. So that's $1,250. So what we just calculated right there, the $1,250, that's the amount that the opportunity tax credit has to be reduced. So if her parents didn't make, too much money is kind of what's going on here. If her parents didn't make above 160,000, they would have been able to claim the full 2,500. But since they make $10,000 more, then they have to take $1,250 away from what would be able to be claimed as the credit. So the amount of credit that gets to be claimed is the 2,500 minus the 1,250 that we just calculated has to be phased out. So, the answer is 1,250. So I know because these two numbers here are the same, maybe that can be confusing, but when you go to do this problem on your own, if you just follow my example, your numbers are going to be different. So the answer wasn't the 1,250 from here, even though it is the same number down here. First, what we calculated here was the amount by which the credit had to be reduced. And then we just happened to also get the same amount of 1,250. So the answer to part A is 1,250. Okay, let's also look at number 22. So here we have Martha and Lou are married taxpayers with $400 of foreign tax withholding from dividends in a mutual fund. They have enough foreign income from the mutual fund to claim the full $400 as a foreign tax credit. Their tax bracket is 24% and they itemize deductions. Should they claim the foreign tax credit or a deduction for foreign taxes on their Schedule A? So first, let's calculate their foreign tax deduction. So if they just did a foreign tax deduction, let me open up my thing here. So for that first one, for the foreign tax deduction, we would take the $400 amount that was withheld times, I like the X better, times, their tax bracket is 24%. That is $96. So this is $96. Whereas claiming the foreign tax credit, and they told us right here they have enough foreign income from the mutual fund to claim the full $400 as a foreign tax credit. So this is $400. Therefore, the taxpayer should, which number is bigger, claim the foreign tax credit in this one. And then just something to reference for this one. This is on, I'm going to point you to page 7-49. This is Learning Objective 7.6. So what we were just looking at is that second point there. U.S. taxpayers are allowed to claim a foreign tax credit on income earned in a foreign country and subject to income taxes in that country. So that's what we're doing there. So the whole purpose of this is to avoid double taxation. So since this married taxpayer is going to have to pay tax on that $400 of income in that other country, then they're not going to have to pay tax on it here in the U.S. So that's why they end up being able to claim that $400 tax credit. So basically what they're doing is saying, okay, you don't have $400 in income here in the U.S., you have it over there, you're going to pay the taxes over there in whatever that country is. Okay, that's it for Chapter 7, Part 2.